Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this is episode 25 of my Dow analysis series. In this video, we'll be analyzing the 7th largest company in the Dow by market cap, which is JPM Chase, ticker symbol JPM. And JPM just announced their earnings today on October 14th when I'm recording this video, so I'm super excited to share that with you guys. JPM is a multinational investment bank and financial services company that splits its business into 4 basic segments. The first segment is consumer and community banking, which offers deposit, cash management, lending, investment, and payment products for consumers and small businesses. Through this segment, they offer credit cards, mortgages, and auto loans and leases. Consumer and community banking provides about 40% of JPM's total revenue. The next segment is corporate and investment banking, which offers investment banking, market making, prime brokerage, and securities and treasury products and services to corporations, financial institutions, and governments. Corporate and investment banking provides about 40% of JPM's total revenue as well. The next segment is commercial banking, which provides comprehensive financial solutions to a wide variety of corporate businesses. This segment provides about 10% of JPM's total revenue. And finally, asset and wealth management is the last segment, which is a global leader in investment and wealth management with total assets of $4.3 trillion. And this segment provides the remaining 10% of JPM's total revenue. Like I mentioned, JPM just reported earnings for the third quarter of 2022. Their revenue for the quarter was up 10% year over year, which was actually driven by a 34% increase in interest income, which was largely due to higher interest rates. However, non-interest revenue was down about 8%, which is due to lower investment banking fees. When we look at net income, this was about $9.7 billion for the quarter, which was actually down 17% year over year, but this was largely driven by a net credit reserve build of $808 million in the quarter, compared to a net credit reserve release of $2.1 billion in the third quarter of 2021. So basically, what this means is that in 2021, interest rates were low and business looked good, so JPM was essentially taking money out of their rainy day fund and using that as income. Now, in this quarter, rates are going up and the economy is looking a bit shaky, so JPM is basically adding to that rainy day fund, which is going to lower their net income. So overall, I think the quarter was pretty good. Even though net income was down substantially, I think it makes sense that they are putting some money away in case things get substantially worse in the economy. Additionally, JPM posted a return on tangible common equity of 18%, which is pretty good to see, I think, given these tougher times we are in right now. I definitely have a lot to learn about banks' balance sheets, but right now, JPM has about $950 billion of cash on hand, which is just the sum of these first 3 items on the balance sheet here. This is actually down from last year when they had about $1.05 trillion of cash. In terms of total assets, these are sitting right now at about $3.77 trillion, which is up less than 1% or $20 billion from last year. And total liabilities are up a similar amount from last year, which is about $18 billion to a total of $3.49 trillion. Looking at debt really isn't all that useful either, because right now we can see they have less than $350 billion of total debt, which we find by adding up short-term borrowings and long-term debt. And as we saw in their cash position earlier, they can easily cover that debt with that cash. So debt is not really a concern. The one thing I do notice is that their accumulated income is actually listed as a loss of around $19 billion, and most of that has really accumulated in the last year. This may sound alarming at first, but to have a low or negative value for accumulated income actually means that JPM is doing an excellent job of reinvesting their earnings back into their business, which is really great for shareholders in the long term. Overall, I really can't say too much about the balance sheet because of the nuance that comes with banks and my lack of knowledge of that nuance, but there's nothing here that's really alarming to me, and I think it's cool to look at the real large scale of this balance sheet with trillions of dollars of assets and liabilities. Looking at the dividend now, JPM has a dividend yield of about 3.7%, which is the highest it's been since early 2020. Their payout ratio right now is incredibly healthy at around 32%, but they have really only been growing that dividend for 10 years consecutively since the 2008 financial crisis. The dividend growth since that time period has been really awesome though, at an average rate of 14% per year over the past 5 years. The sad thing though is that JPM has not announced a dividend raise this year. Normally they do announce that raise in September, but because of Fed stress tests earlier in the year, they didn't announce that increase. So although they didn't announce the dividend increase in 2022, they're still going to pay 8% more dividends in 2022 compared to 2021, which is still a good sign to see. I definitely expect them to raise the dividend sometime in 2023 if things start to improve or kind of stay the same, but who knows what will happen. Things could definitely get much worse in the economy. We really aren't sure at this point. In terms of the safety of the current dividend, I think it's pretty safe, but unfortunately, I think the next few years hold some uncertainty, like I said, in regards to dividend increases. When we move on to valuation, the traditional methods I normally use, such as the PE ratio or a discounted cash flow model, don't really work as well for banks. So we're going to be using the price to tangible book value. And basically, tangible book value is the value of the business if all the assets on the balance sheet are liquidated and all the liabilities are paid off. It's called tangible as well because it doesn't include items like goodwill and other intangible assets. So price to tangible book value is basically just the price divided by the tangible book value per share. So anything below 1 means the company is technically undervalued. For JP Morgan, they have very rarely had a price to tangible book value below 1. This has only happened about 4 times since 2000, and these were very brief periods that it stayed below 1. Currently, that number is 1.59. So because of that, I don't think this is really too high of a valuation, even though that number of price to tangible book value is above 1. Historically, JP Morgan's price to tangible book value has been above 1, so that's okay to see. But I don't think it's really all that undervalued right now. Closer to $100 per share starts to look a little bit better for me, and I have been buying some in that range of around $100 per share just a few days ago, but the stock market has rallied a little bit, and after they released their earnings, the JP Morgan stock increased in price a little bit as well. Looking now at the 3-year chart, we can see that JP Morgan has really pulled back a lot from their highs of around $170 per share, which happened about a year ago. They are now also well below their January 2020 highs of around $140, but the stock did get as low as $76 in March of 2020. So we could see a little bit more falling action here in the stock price. What I do find very interesting is if we look out at a 20-year time frame on the stock, we can see a few different trend lines that I drew here, and they are all kind of pointing to the area of $90 per share. So I think that could be a pretty good price from a technical level, and as we saw earlier when looking at the price to tangible book value, that could be a pretty good price from a fundamental level as well. Although JP Morgan is a fantastic company, I don't think the stock is quite as undervalued as a lot of people might think. I have been buying some, like I mentioned, below $110 per share, but I certainly think the stock could go a lot lower, and the economic uncertainty of the next few quarters could certainly make that happen. If the stock does get to $90 or below, I'll definitely be buying some more and probably be pretty excited about it. Over the long term, I think JP Morgan will do a great job, though, of providing value to shareholders through investing back into their business, repurchasing shares, and paying an ever-increasing dividend. But I would love to hear your guys' thoughts on the fair value of JP Morgan stock, and if you have been buying any recently, so let me know down in the comments below. If you are interested in checking out a video that I made about another financial company in the Dow, you can check out this video up here about Goldman Sachs stock. Thanks for watching, and I'll see you all in the next one.